And while we don't like to always focus so much on short-term performance, we do certainly think it's important to, understand what's going on and of course feel comfortable with that long-term plan that we've talked about with how you're invested. Because, right now this is an example of some of the headlines that we're seeing in the news recently, which doesn't exactly help you feel comfortable probably. The words like the worst drawdown in history and sell everything. And, while these headlines are technically correct, I think it's important to take a step back and look at, what these numbers, what's actually, happening. And this is a chart of what this historic decline in the bond market looks like. This is a chart of the performance of the general bond market over the last 20 years. And the recent decline then is the drop that's on the far right side of this chart here, in which if you just look at the chart, paints a much less dramatic picture than the headlines, I think. And, the value of a broad global bond index has still more than doubled over 20 years, which, not bad for that safe and conservative part of your portfolio that it is. And we're back to where we were about 2 years ago. And so while certainly not great, perhaps not as dire as those headlines might kind of leave you thinking if you just read them. So a good example of being careful, not getting really excited by any sensational headlines like we're seeing today or will inevitably see in the future. And not to make light of what is, a decline in the value of your investments, but I think it's important to put these scary headlines just in perspective. What makes this period feel a little bit different and, maybe why we're doing this webinar and had these questions is not necessarily because of the magnitude of the decline, but it's volatility and a decline in a part of your portfolio that historically has been, pretty stable. And so the headlines are right. Technically, this is a large drawdown relative to the history of the bond market, but this is nothing like, an equally historic drop in the stock market would be. And so, if the general stock market was down 10%, that's something we're used to seeing much more regularly. Historically, you see that just about every year. But this volatility is occurring in, like I said, a part of your portfolio you're not used to seeing it in. So we thought it was worth just spending some time looking into it. So maybe to start, what are the primary risks for bonds? Since bonds are just fixed payments over a certain period of time, it's easy to see why today's environment might, not necessarily be so great for bonds. Rising interest rates mean that new bonds being sold today have higher interest rates. And so bonds that were previously purchased with yesterday's lower interest rates become less valuable. And then, of course, inflation is bad for fixed income because that interest payment, that fixed interest payment that you get every year loses purchasing power, year after year. And that's made worse by higher inflation like we're seeing right now. And so it's probably not a surprise to anyone that these two things are precisely what's happening today. And just to give an example of how this works and the impact it could be expected to have, here's just a very general example. Just to make the math easy, let's assume you buy a $100 bond that pays $5 per year in interest, or said another way, the bond has a 5% yield. And so let's say you purchased that 5% bond last year, and then this year interest rates rise and all new bonds are being issued with a 6% yield. So what happens to your old 5% yielding bond? Well, no one's going to buy a 5% yielding bond for full price when they could get a 6% yield, for $100. And so you'd see a decline in the market value of that bond if you have to sell it, right now before it matures. And that's an important point I'll get to in just a sec. But if you have to sell this 5% yielding bond now, when general interest rates rise to 6%, you would expect to see a decline in the value of that bond, and enough to make it where that $5 interest is equal to about the same interest rate as other bonds have at the time. This math is a little bit extreme because it's assuming kind of a perpetual bond or one that doesn't mature. In reality, though, the math gets a little more complicated because it also depends on how long-term of a bond you have or when the bond matures. Because remember how bonds work is you get your principal back once the bond matures. And so for this example, you gave a company or a government $100, they're paying you $5 a year. And then once that bond matures, whenever that is, you get your $100 back. And so for this example, the investor that holds this bond that's now worth $83, is probably looking, saying like, ouch, that's 17% decline, that hurts. But if they hold this bond to maturity, they would get their $100 back. And so that loss they're seeing is, a paper loss, as some would say, and it doesn't have to be recognized. They will get that initial principal back as long as the bond, holder doesn't default before maturity. And so the price chart of this bond over time might look like something like this chart here, where it started at $100 when it was originally issued, had fallen in value as interest rates rise, and then as it gets closer to maturity, would slowly increase back to that $100 value. And so while it's true that other bondholders of those 6% bonds might be getting more interest, the real cost here for this bondholder, if they don't sell, is receiving less interest in the future. It's not so much a worry of a 17% decline in the value of their investments. So all this is a little bit generalized because all of our clients here don't own just a single bond like this kind of example is here. You own bond funds that are made up of many thousands of individual bonds. And so there are many, thousand variations of this chart and this math here going on at the same time. And then, of course, all those thousands of different bonds have different maturities, and different maturity bonds all behave a little bit differently. Long-term bonds, say a 30-year treasury bond, is much more sensitive to rising interest rates and inflation because you're kind of locked into that for 30 years. A one-year bond is going to be much less sensitive because after a year, the bond's going to mature and you can reinvest at higher rates. And maybe the best way just to show that is to look at how different types of bonds have been trading over the last year. So this is a chart showing the performance of 5, pretty different types of bonds or bond funds and how they've performed. As I said in the last slide, short-term bonds, as shown in yellow in the chart, have much less sensitivity to rising interest rates and inflation like we're seeing today because they mature soon. The investors are going to get their principal back soon and can reinvest that relatively soon. So investors in short-term bonds are not as worried about rising interest rates because they're not really locked into a longer-term bond. So this year, short-term bonds, we're seeing about a 3% decline, so far. But as you can see, long-term bonds, the most extreme shown in the blue line here, are down much more significantly. This is a bond fund that owns 20-year or more in maturity treasury bonds, so very long-term. And as you can see here, much more sensitive to rising rates, down about 15% over the last year. And for our clients, we use a mix of what's called total bonds. So that's the purple line here. Total bonds is just kind of nomenclature for a very diversified set, owns a little bit of everything. So some treasuries, some short-term, some corporate bonds. And as you can kind of see, it's right in the middle of these other types of bonds that we're showing here. But for our clients, we're usually in a mix somewhere between short-term bonds and total bonds, just between your risk tolerance, spending needs, and things like that. So I think it's worth noting that some investors over the last few years really started taking a lot of risk in their fixed income, their bond portion of their portfolio, because interest rates were so low. And for a while, long-term treasuries looked nice because they had higher interest rates than many of these other types of bonds. But now they're starting to recognize, the trade-off of that little bit higher interest rate was that you're much more susceptible to any rise in interest rates. And we're definitely seeing that now. And, maybe just for fun, I did include a couple other notable examples. There are more extreme things like levered bond funds, or a few years ago, Austria made headlines for selling a 100-year bond. That's down about a little more than 50% right now. And so, investors that really reached for yield and some things that we kind of cautioned against, and a lot of people cautioned against, are certainly kind of paying the price right now, unfortunately. But as I said before, what makes this decline maybe feel a little bit worse is that it's happening at the same time as a decline in the general stock market. Typically, you've probably heard us talking about how we use bonds for their diversification, because a lot of times when stocks have declined, bonds tend to do well. And that's not happening now, which is a somewhat rare occurrence, but certainly not unprecedented. And so just for fun, I thought I'd show some numbers on how often declines in the stock market, the bond market, and then both at the same time happen. And so historically, the stock market has a decline about once every 4 years. There's been 25 negative years in the S&P 500s since 1928. And maybe what a lot of people don't realize is that bonds do have negative years, a little bit less frequently, about 1 in every 5 years though. But the idea of a bond market declining in value is not unheard of by any means. What is perhaps more unique is when both are down at the same time. And so there's been just 5 calendar years since 1928 that both stocks and bonds were down. And, if the year ended where we're at today, it would be the 6th time, in history. And in those 4 times, so 1931, in those 5 times, 1931, 37, 74, 69, and 2018, I listed here the performance of a balanced investment portfolio, one that's 60% stocks and 40% bonds, and the decline that an investor would have seen that year in their portfolio. And again, you can see year to date, we're right about historically, right in the middle of what's happened in prior years where both stocks and bonds declined in value. And so again, not great to see. No one loves to see a decline in their investment portfolio, but we all know that short-term declines are something we're always going to have to experience when investing. And what's more important to focus on is longer-term returns. And even if we just look out 5 years from those periods in history when both stocks and bonds declined in the same year, we can see that not panicking was certainly the right decision in these instances. There have been periods of negative 5-year returns historically, but maybe interestingly enough, none of them have ever come after a year when we've seen stocks and bonds decline at the same time. And just for fun, if we want to look out even longer, 10 years, the returns just get better and approach, more what is just an average return for a portfolio. And so I just kind of wanted to include some of this data because the headlines today, paint such a dire picture, talk about how general investing philosophy is dead and you need, new types of investments and things like that. We have seen what we're seeing now before, and it was never a sign of a big change that needed to happen in your investments or the economy, how you manage your portfolio, anything like that. In fact, some of these years, maybe just not that notable in the grand scheme of things. And so obviously we don't know what is going to happen in the next 5 or 10 years like we just looked at, but we do know that long-term thinking and discipline has always rewarded investors. And so I really like this chart from DFA that overlays the general stock market performance with all the scary headlines and events we've seen over the past 50 years. It's a few years old now, but just, in general, $1 invested in a diversified index of stocks in 1970 is worth well more than $50 today, despite everything we've been through. And what I really liked about this is that some of the headlines on this chart match exactly what we're experiencing or what people are concerned about potentially experiencing now. Increases in the price of oil, double-digit inflation, wars, countries defaulting, things like that. And so, this chart, like I said, is the stock market, and so not necessarily the bond market, but as that chart, the first chart that we showed earlier in this, the same story holds true for bond investors too. This is just a 20-year chart here, so not quite the 50 years we were just looking at on the last slide, but still represents a lot of history for a bond investor. And I highlighted on this chart a few periods of rising interest rates or inflation that we've seen in the past. And what I hope is obvious is that with a long-term view, these events seem relatively minor, even though what happened in these periods in red was certainly notable at the time, had similar headlines about the general investing philosophy being dead or needing to do drastic changes. Just for example, 2004, 2005, the Federal Reserve raised interest rates 17 times in total. Rates went from 1% to 5%. Inflation was around 7% at that time, pretty close to what we're experiencing now. And, if you zoom out and take a longer look than just a year or two at some of these events, hopefully you realize that periods like this are not as significant as they seem as when you're living through them, like we are today with some of the headlines and news today. And to end with a little bit of optimism, I just thought it would be good to think about some positives for rising interest rates. And so shown here is just the chart of the yield on a 5-year Treasury bond. As you can see, the yield for this bond has quadrupled, almost quintupled just over the last 9 months or so. And for someone who's looking to get some kind of interest from their risk-free investment like a U.S. Treasury bond, this might be a good thing. No one liked getting 0.5% from their bonds, and so hopefully we're getting back to what a lot of people would call a more normal time when an investor can expect some type of income from their bonds. And this is great as we start thinking about sustainable withdrawal rates for clients. There's that 4% rule, which just just says that 4%, withdrawing 4% of your portfolio in a year has always been a very conservative amount. You've been able to weather, prior stock market declines. And if we start thinking of being able to count on 2.5% interest on the fixed income portion of your portfolio, that does a lot to kind of help take some of the need for stocks to really perform well if we're trying to set a sustainable withdrawal rate. And so in the long run, I don't think an increase back to these more normal levels of interest rates should be considered a bad thing. Looking forward, I think some higher level of interest rates for savings and investments would be well received by a lot of people. And so just to summarize and kind of finish off our webinar here, you have been and will continue to be rewarded for being disciplined with your investing. Keep a long-term approach and don't take unnecessary risks to try to increase short-term returns. We're seeing today people that did that by switching to very long-term bonds or leveraged bonds, things like that to try to reach for yield are certainly paying the price today. And while the rise in interest rates does seem a little unusual since we've had low interest rates for so long, this is necessary to kind of get back to what we think of as normal and what a lot of people eventually want for that bond portion of their investments. This is hopefully getting us to a more healthy investment environment. And then just know that as we talk through managing your investments, we always have and continue to err on the conservative side. If you're doing regular withdrawals, we've talked about having short-term bonds, having cash, having maybe some money markets set up for periods just like we're seeing now where, if things do continue to get a little worse, you're going to have a few months of reserves left over. We won't have to panic and sell investments that are down. And if this persists, we can get even more strategic in how we sell off certain types of investments like shorter term bonds to let your other investments recover. And just as always, know that diversification is going to be the key for weathering this type of volatility that we're seeing today. Putting all your bond investments into one type of bond is risky. A diversified approach is going to be the only sure way to ensure that you're invested in a safe and sustainable manner and invested in what's going to produce returns in the future.